Your parents told you to save money, and for them, that advice actually worked. But if you're following that same advice today, you're not building wealth, you're actively losing money. So in this video, I'm going to show you exactly why saving money doesn't make you wealthy anymore and what actually does. The first thing you need to understand is that saving money used to build wealth because saving accounts paid enough interest to beat inflation. Today, they don't. The average savings account right now pays about 0.45% interest, and high yield savings accounts, if you shop around, pay about 3 to 4%. But inflation over the last few years has averaged at around 3.5%. So let's say that you save $50,000 in a regular savings account for 30 years. After 30 years, your account would be roughly around $57,000. And on paper, it looks like you made money. But once you adjust for inflation, your purchasing power is dramatically lower than when you started. And you've lost well over half of what that money could originally buy. So even though you did the responsible thing, the system punished you for it. Even in a high yield savings account at let's say 3.5%, after 30 years, you basically break even, but you're not building wealth. Now compare that to the S&P 500. Same $50,000, same 30 years. With a historical average return of about 10%, your money would go from $50K to around $870,000. That's close to a 2,000% gain, and even adjusted for inflation, you still made a lot of money. In both of these scenarios I just described, you had the same starting amount and it's the same time period, but you're over 5 times wealthier just because you invested instead of saved. And this is why saving doesn't work anymore. The returns don't beat inflation by enough to actually build wealth. But why did saving work for your parents and not for you? And that's because the system fundamentally changed. In the 1970s and 80s, savings accounts paid 4 to 6% interest, and inflation was running about 2 to 4% on average. So outside of that crazy 1970s spike, you were making a real return of about 2 to 3% per year just by saving. You literally got wealthier by doing nothing, and that's why your parents' advice was to save, because for them, it actually worked. So how did this change happen from your parents' time to your time? Well, basically, from the 1930s to the 1980s, there was a banking rule called Regulation Q that limited how banks could price interest on deposits. Over time, as that rule was phased out and the banking system became much more consolidated, banks had less incentive to compete aggressively for your savings. Back in the 1970s and early 1980s, it wasn't unusual to see CDs paying 8 to 12% interest. So even after inflation, savers could earn real returns just by keeping money in the bank. Saving actually built your purchasing power. But once Regulation Q was fully phased out in the mid-1980s, saving rates gradually drifted lower. Banks increasingly relied on cheap deposits, and they didn't need to reward savers the way they used to. So we went from an environment where savers could earn positive real returns on cash to one where savings often fail to keep up with inflation. And today, your money slowly loses purchasing power just by sitting in the bank, and that's a complete reversal from what your parents experienced. Then came the 2008 financial crisis. The Fed dropped interest rates to 0 and held them there for 7 years. Banks could borrow from the Fed at 0%, so why would they ever pay you 4%? And that caused saving rates to collapse, and it happened again in 2020 with COVID. Rates went to 0, the Fed created trillions in new money, inflation spiked to 9%, and your savings account was only paying 0.3%. You were losing 8.7% of your wealth per year just by saving. The game completely changed. Now, to understand how banks get away with basically paying you nothing to keep your money with them, you have to understand a bit about how banks make money. Banks make money on the spread between what they pay you and what they charge borrowers. When you deposit $100, they pay you 0.5% annually or 50 cents a year, but they lend that $100 to someone else at 7% annually or $7 a year. And they keep the spread. In this case, it'd be $6.50. And the bigger the gap, the more profit they make. And right now, that gap is huge. Compare the average savings rate, 0.45%, to the average credit card rate, 21%. or the average mortgage 7%, or the average auto loan 7.5%. Banks are making record profits on these spreads, so why would they ever raise the savings rate? They don't have to. 70% of Americans have used the same bank for over 10 years. People don't shop around anymore for better rates. So banks keep paying you almost nothing because they know you're probably not going anywhere. And people see FDIC insured up to 250K and they feel safe. But what are you safe from? Bank failure? Sure. But inflation? Absolutely not. You're safely losing wealth every single year. Now here's some traditional advice I actually agree with, and that is you need an emergency fund. If your monthly expenses are around $4,000, you should have 3 to 6 months saved in a high yield savings account. That's anywhere between $12,000 to $24,000 in liquid cash for things like emergencies, job loss, medical bills, car repair, whatever. This money needs to be accessible immediately. So yes, you should keep it in your savings. I would never recommend to keep emergency savings in stocks because you may have an emergency and now you have to sell for a loss when you'd rather have held those stocks for years, especially things like index funds. But here's where people mess up. They either save nothing at all or they keep way more than 6 months expense. They keep like $50,000, $70,000, $100,000 in savings just in case or because they're figuring out what to do with it. That's where you're destroying wealth. Because let's say you have $75,000 in savings and $24,000 is your 6-month emergency fund, that's fine. But the other $50,000 that's sitting there for 30 years in your savings, you're giving up hundreds of thousands of dollars in potential earnings by not investing. The rule is simple. Emergency fund, keep it in your high yield savings account, and everything else gets invested. Once you hit that 3 to 6 months of expenses saved up, every additional dollar should be going into index funds, retirement accounts, real estate, basically anything that grows faster than inflation. And you have to understand that saving is not a wealth building strategy. So if savings doesn't work, what actually does build wealth? And there are basically 3 things that since financial markets have been invented, they have helped people build wealth. And that's stocks, real estate, and businesses. So let's go over the pros and cons of each of them. With stocks, the S&P 500 has returned about 10% annually for the last 100 years. Even if you bought at the worst possible times, like right before every crash, you still came out ahead over 30 years. Meanwhile, there has never been a 30-year period where cash in a savings account has kept up with inflation. The data is overwhelming. Low-cost index funds like VOO or VTI, automatic monthly contributions, and never trying to time the market. That's how you build wealth the easiest. There's almost no risk, but it does take time. Next is real estate, and this is where leverage comes in. You can put $100,000 on a $500K property, and the property can appreciate 5% in a year. That's around $25,000 in appreciation. But since you only had to put in $100K, you make a 25% return on your money. Plus, you're basically paying your mortgage with rent from tenants, and you're paying it back with inflated dollars. Meanwhile, property values and rents are always rising with inflation. And this is why real estate has historically been one of the best inflation hedges. You can buy a duplex, live in one unit, and rent out the other, so you're basically building equity while somebody else pays your mortgage. And you guys should always be trying to max out your tax advantage accounts. Things like your 401k, your Roth IRA, your HSA if you're eligible. These things offer massive tax advantages. They literally let your investments grow tax-free or tax-deferred, which means you keep way more of your returns compared to a taxable savings account. A Roth IRA growing at 10% for 30 years absolutely destroys a savings account at 0.5% per year. And you pay 0 taxes on the gains when you withdraw in retirement. So now that we went over everything, your main takeaway from this video should be this. Build your emergency fund, then invest everything else into things like index funds, real estate, retirement accounts, basically any assets that grow faster than inflation. And that's how you build wealth in 2026, not by savings. The rules of wealth changed since your parents' time, and if you want to build wealth moving forward, you have to adapt.